Welcome to the quarterly webinar of Renaissance Investment Managers, and it gives me indeed pleasure to welcome you all for this quarter's webinar. Let me straight away jump into the topic and to the deck that I have to share with you all. To begin with, all of us know that what we've experienced in the last 5 months or 4 months has been a perfect energy shock for the global economy, and obviously it impacts India significantly because all of us know India imports 90% of its energy, and a significant increase in energy prices does impact India adversely. The good thing is the quarter started with this whole Iran war, what we thought will get over in few weeks, extended to almost 3 months, and the peace deal lasted only for 4 weeks, and now we are in midst of another conflict or Hormuz blockade, as we call it. Having said that, I think I still believe, or I think the market still believe, that probably the same trend will continue, which is TACO. So currently, while the decline in oil prices, what it also showed was that the moment the peace deal was signed, within 3 weeks time, oil prices were back to where they were pre-conflict at $70, which effectively means that as far as demand supply balance is concerned, it's completely in the favor. Oil markets are pretty easy, and there is enough supply in the oil market. What created higher oil price was this whole Hormuz blockade and the transportation issues. Probably while we have another round of blockade now, I think markets this time around are less panicky or less concerned than what they were last time around, because markets still believe in, as I said, TACO, which effectively means markets believe that President Trump will make a U-turn some point of time, and probably unlikely that this blockade will persist for a longer duration. Having said that, just to put things in context, India's oil import bill was about $128 billion last year. As I said, we import 90% of our energy. Now, depending on how things play out, because things are changing so fast on a weekly and on a monthly basis, as all of us can see, that from where oil price went from $70 to over $100 and back to $70, and now we are back to $85. If we presume that the current $85 of oil prices persist, probably India will end up, for this financial year, India's oil import bill will go up by about $40 billion, which is about 1% of our GDP, to $170 billion. In case that happens, that's a meaningful impact for India. Having said that, what I really want to highlight is, and it will impact India adversely, but what I want to really highlight is two things. One, India has the ability to deal with it. And before I go to that, I just want to show you this as a longer term trend. This is a very interesting chart. It shows Indian economy's oil intensity over the last 20 or 25 years. And what you can really see here, as the economy is growing, as the economy is becoming more larger and it's becoming more diversified, and our growth is more driven by services than by manufacturing, which is actually the case, our oil intensity has consistently come down. So now for every incremental unit of growth or GDP per unit of growth that we generate or output we generate, we are using almost half the oil that we were consuming in 2007. So that's a very good sign in that context. Having said that, our dependence still remains. Just to put things in context, what I was saying was, the good thing is, while higher oil price will have an impact on India's macroeconomic fundamentals and India's growth, but the point I want to highlight is that India has the ability to deal with it. Over the last 10 years or 12 years, if you see, India's macroeconomic fundamentals have been very, very stable. Over the last 10 years, we've had a real growth of about 6.8% on an average, pretty healthy and pretty consistent, I would say, if you see here. Our forex reserves have more than doubled from $300 billion to closer to $700 billion where we are. The oil prices and some of these macro headwinds that we experienced in the last 12 months have had an impact on our currency. There's been a currency adjustment, sharp currency adjustment that has happened. Indian rupee, all of us know, has adjusted by about almost 10.5% versus the dollar. But I believe that now, probably given the incremental steps that RBI has taken, rupee is stabilized, and we'll talk a bit about it. But the point I want to highlight is, given India's stable growth and India's central government has been fairly prudent in doing fiscal management of the economy. Our fiscal deficit has been about 4.5% on consistent over the last 10 or 12 years, despite COVID shocks. We did have some fiscal expansion during COVID, but we have brought it back to where we were pre-COVID. There could be some consequent impact on higher current account deficit because of higher oil prices if oil prices persist at these levels, but I believe that is already priced into the market. So the one point I really want to highlight is, any crisis of this sort eventually is transitory. Someday it has to get solved. We've had oil crisis in the past as well. Whenever we get these kind of oil shocks because of some crisis, event or a war, they tend to persist, but for a period of time, and eventually it solves one way or the other. And I believe likewise this crisis will also get resolved. And what will help India, while it has already impacted India, or it will have an impact on India, but we have the ability to deal with it, and it does not disrupt or derail India's medium-term, long-term growth story. While it might have some short-term impact, and the point I'm trying to make is, even that short-term impact, we've already absorbed or baked that in our macroeconomic fundamentals. India's macros are stabilizing, which is the point I was saying. We've had a sharp adjustments in the currency in the last 12 months, but after that it seems, RBI, all of us know, RBI has taken quite a few concrete steps. The recent announcement of RBI of FCNR deposits should yield about $45-50 billion in terms of FCNR flows into India. We had seen a very sharp spike in 10-year bond yields when the war was announced and the oil prices spiked. But now bond yields have come back to where they were at about 6.8%. So India's macroeconomic fundamentals, as markets already reflecting that stability in India's macroeconomic fundamentals. And experience tells us that events like this or crises like this tend to be a great entry point to be investing into Indian equities. Because please try to understand this, that when we get a crisis like this, markets are short-term discounting machines. So they tend to price in that crisis at that particular point of time. Eventually every crisis gets solved. India's medium-term, long-term growth story remains very much in place. Once the crisis gets over, equities, because markets fall, equity tends to get suppressed. But as the crisis gets over, India reverts back to its mean growth rate. And as that happens, markets tend to bounce back very sharply. Historically, we've seen, if you see these multiple events or scores of events that have happened in the last 20 years, all of them show or demonstrate that investment made during those period of crisis tend to yield significantly higher returns, because 6 months and 1 year out of those crises, Indian markets tend to deliver very strong returns. If you go back to global financial crisis of 2008, the crisis was very brutal. The world economy almost came on the brink, with failures of large financial institutions in US and globally, and Indian markets fell very sharply at about 60% during that period. But 1 year out of those crises, markets were up by almost 100%, and they had regained all their fall. And likewise with every other crisis, including COVID pandemic, when markets fell by almost about 40%, but 1 year out of those crises, markets were up by 95%. So the point I'm trying to say is, I still believe that while we have a relapse of this crisis, if I may call so, because of the second round of Hormuz blockade, but that will get resolved. And as I said, crises like these are to be great entry points to be investing into Indian equities, because we know that 6 months or 1 year out of those crises, markets tend to deliver very strong or very healthy returns. And I think which is what we should be looking forward to this year as well. And so I firmly believe that after 2 years of almost very flattish index returns, where valuations have become have become reasonably attractive or are pretty much in line with long-term averages, this is a good entry point to be investing into Indian equities incrementally. As I said, India's macroeconomic fundamentals are already stabilizing, and some of this already showing in the currency markets and in the bond markets. We still think that even if oil prices persist at $85, India can still do a 6.5% growth this year, which is not bad. And if in case oil price get back to $70 as they were pre-crisis, pre this war, then probably we can be doing 7% growth as well this year. So I think our growth still, reflects the resilience of the Indian economy, I think. So the underlying economy continues to remain fairly resilient, and which is what makes me feel optimistic about equity as an asset class going forward, that the underlying growth is strong, markets have underperformed in the last 2 years, and valuations have become reasonable. Markets, as I was trying to highlight, markets are already pricing in a lot of bad news, and which is why I believe that probably this is a good entry point to be investing into Indian markets. When I look at not only not only absolute factors, but even relative terms, when I look relative to Indian markets long-term history and also relative to the world, Indian markets are at a very attractive entry point. Meaning, if you look at this slide, this is price to book, relative price to book of India versus MSA emerging markets. All of us know that India has underperformed emerging markets big time in the last 2 years. So some of the other emerging markets which have AI driven investments or AI driven companies have done well. India does not have those kind of companies or investment opportunities, and so India has been at the receiving end where global investors have taken money out of India and gone into those markets. But having said that, what that has really done is made India and mind you, I'm talking about price to book. While earnings are a near-term valuation indicator because they tend to move very sharply with economic cycles and business cycles, net worth and book value tends to be a more tangible store of value, and it doesn't deviate very strongly. On a price to book basis, Indian markets versus the world markets are at a point where they have been, during 2008 financial crisis or during COVID crisis. So what this underperformance has done is made India really very attractive from a valuation perspective, both relative to the world in terms of price to book or every other metric I look at, India's market cap to the global market cap and the contribution in the context of market cap to GDP ratio. Again, India has become very attractive in relation to a lot of other markets in the world. And as I said, India's performance, India has not had such a big underperformance versus emerging markets ever. The last time India had such a big underperformance versus emerging markets goes back to 1995. We're seeing such a sharp underperformance for India after a gap of 30 years. And meaning even last time when India had such underperformance, there was a very sharp rebound in the next 3 years in Indian markets in absolute terms and also in relation to the world. And I believe something lies, I am of the same camp that believing that something similar lies ahead of us over the next few years. Even in absolute terms, just to make that point, why I see that Indian markets are very attractive, you look at this chart, this is very interesting. Now, while all of these crises and chaos has happened and Indian markets have underperformed for the last 2 years, what we are seeing is India's nominal GDP growth has been very steady at about 10-11% and probably will accelerate this year. Yeah, last year was a shade lower, but they will accelerate this year. And because we've had so many challenges in terms of rising commodity prices and now this war and tariff issues in the last year, and so obviously corporate earnings have been on a sluggish earnings growth. As a result, we have created a very big wedge between nominal GDP growth and corporate earnings growth. We have seen in the past cycles as well that when business cycle and economy and the world normalizes, corporate earnings tend to come back. Corporates pull back their margins, which have taken an hit in the short term. They tend to pull it back as and when the economy normalizes, and which effectively means that bigger the wedge, it creates a more attractive entry point for a longer term investor. And I think we are seeing that, and probably this kind of a gap between underlying economic growth and profits we're seeing after a very, very long time. So which opens a very attractive opportunity for investment into equity as an asset class. When we look at earning cycles, already, as I said, the nominal GDP growth, which has slowed down last year, has already started picking up, and we see a regression of earnings growth to nominal GDP growth. There's a very strong correlation with a 12 to 18 months lag. So now that the nominal GDP growth has started showing traction on a 2-year rolling basis, it's a matter of time before corporate earnings starts catching up, and even on a bottom-up basis, we are seeing early signs of it. And I'll talk a bit about it. So the point I'm going to highlight is from a top-down perspective, from every data point on an absolute basis or a relative basis, I look at it, I find equity as very attractively placed from an investing perspective from here over the next, while the long-term story in India remains, but within that long-term, you get those cycles where equities are very attractively priced, and when you invest at that point of time, you tend to generate significantly higher returns over the next 12 to 24 months. And I think Indian equities, after 2 years of underperformance, is at one such point at this point of time. In midst of all of this war and all of that, I think the long-term India growth story remains very much in place. If you look at the long-term trends, and I think this is a beautiful table. If you look at the Nifty 50 index over the last 20 years, in every 5-year cycle, Nifty's returns have been very consistent on a 5-year basis, between 12 to 14%. Even the last 5 years, despite 2 years of underperformance, and this is analyzed data, calendar year data ending December, 5 years ending December 25, despite underperformance, Nifty has done 14.9% CAGR return over the 5 years. So obviously the excess returns were upfronted, but those excess returns have got normalized, and now Nifty returns are very much in line with long-term averages. As you can see here, across time horizons, Nifty has done about 13 to 14% CAGR returns. So Nifty has been a very, very consistent performer, and that's a reflection of the underlying stable growth of the underlying economy. And this growth has been, Nifty returns have been pretty much been backed by very consistent earnings growth in Nifty companies at about 10-12% CAGR over a longer time period. So, which is what gives confidence that there is no reason why we should not, given that India's growth continues to remain consistent and stable, why we should not have this trend going forward as well. And we believe over the next 5 years, Nifty should do a 14% CAGR returns from here on. But having said that, as I said, we certainly believe that the returns could be upfronted in the next 2 years, where we think much higher returns than what will accrue over a 5-year cycle, over the next 5-year cycle in the next 2 years, as it happened in the last 5 years, where returns were upfronted in 2021 and 22, and the last 2 years were flattish kind of a thing. So we think now that we're coming out of an underperformance cycle for India, returns could get upfronted in this cycle. Maybe I can come back to these on flows. So the point I want to highlight is we still believe that the longer term India story remains very much in place despite the geopolitical conflicts, and now that we're in midst of, meaning we've been calling this, all of us know that we were in the midst of a war, which was Russia-Ukraine, which is now 4.5 years. We are in the 5th year of that war. None of us expected it to last so long. In fact, an interesting data point is that the Russia-Ukraine war is now longer in terms of duration than what World War II was. So yeah, surprising, but that is what it is, and we are in the midst of now the second conflict. Despite all of this, the India long-term story remains very much in place. We still believe that India can keep growing at about 7% real growth and about 11 to 12%, 11% nominal growth over the next 7 to 8 years, which effectively means we'll double our size of the economy from $4 trillion to $8 trillion by 2030 to 33. And if that be the case, then there is no reason why market should not double over the same period of time, which effectively again dovetails into the same view that index can do a 14 to 15% CAGR returns over the next 5 years. And if that be the case, then we will become a $10 trillion market cap from where we are at $5 trillion in the next 6 to 7 years or thereabouts. Again, coming back to market, maybe another yardstick is, as I said, even in absolute basis, if you look at it, Indian markets have become very attractive, because what this crisis has done is effectively, if you see, the Nifty index is now probably at the lowest point in terms of valuations where it has been in the last 5 years of this cycle, at about 18 times 1 year forward earnings. So what this has really done is made markets really attractive. More importantly, as I've been saying this, Indian markets have been very consistent performer over the last 15 years. If you see anyone invest on a calendar year basis, Indian markets have delivered positive returns in 13 out of last 15 years. Outside of US, no markets has had this level of consistency in terms of returns or outcomes. And again, as I said, just to reiterate once again, that reflects the underlying resilience and stability of an economy. Anyone investing into Indian markets and staying invested for a year, the probability of making positive returns is like 13 out of 15, which is like pretty high, 85% plus. And anyone staying invested for a period of 2 years, virtually his probability of making money is 100%. So I think that's the consistency and stability that Indian markets offer. I touched briefly upon the earnings cycle. So this is what I wanted to highlight, that we had very strong earnings growth for 4 years out of COVID. When we came out of COVID lockdown, Nifty earnings grew at 18% CAGR, and we almost doubled Nifty earnings from 500 where they were during COVID to about 1100 rupees in CY24. CY25 was a year of consolidation for earnings growth because of rising commodity prices post the Russia-Ukraine war. It did have some impact on earnings growth, and earnings growth fell sharply to about 4%. We still hope that probably this year we will see earnings acceleration, though it will be somewhat more moderate than what we were expecting at the start of the year, because there is some impact, though transitory, of higher oil price and commodity prices that has happened during these 3 months, which will spill over into corporate earnings and will hurt corporate margins, because companies have not fully passed on raw material price increases to their customers because they believe this is transitory. So while they have taken some price hikes, but they have not completely passed through cost push to the consumer because they don't want to hurt demand, and as a result it might impact some bit of their profitability. But the more important point, what I am seeing from our conversation and from companies across sectors, is the underlying demand in the economy is fairly resilient, and it is holding up despite this conflict. So which shows that there is a lot of latent demand that exists in the economy, and I think that should support earnings in the second half of this year and going into the next year. So we certainly see that the worst of earnings slowdown is behind us, and we are on a path of earning acceleration from here on. Probably this year closer to the double-digit growth, and next year certainly to mid-teens kind of earnings growth, which is what our normalized earnings growth is. And if when you get into this kind of acceleration to earnings growth, markets tend to deliver healthy returns. So the point I'm going to say is all of those stars are aligning for healthy returns in markets in terms of acceleration, corporate earnings growth, equities having underperformed, foreigners having sold big time to Indian equities. All of us know this. That foreigners have sold big time. As I was highlighting, that in the last 18 months, foreigners have taken out $50 billion out of Indian equity, which is very significant. And probably now post-COVID, in the last 6 years, foreigners have, meaning all the money they have put in, including appreciation, they have taken it out of India. As a consequence, foreign ownership of Indian equity is down from where it was at peak at closer to 22% to about 16% or thereabouts now. The good thing is that all of that selling has been absorbed by domestic investors, and the good thing is that we are seeing higher allocation of domestic savings to Indian equities, which makes our markets much more stable. Earlier, one could not have imagined that this level of this magnitude of foreign selling can be absorbed by Indian markets. The very fact that we have domestic investors putting money, allocating savings to equities, we've been able to absorb that saving, and that makes our markets much more deeper and more resilient, and which is a good thing. And I firmly believe that at some point of time these foreigners will come back, and my view there is probably towards the later part of this year or early next year they will come back, and I'll talk a bit about that as well. So I think that makes our markets more deeper, more resilient, and provides good entry point for domestic investors. Long term, all of us strongly believe in India growth story, and consequently equity as an asset class. I don't think so there's any second thought about that. One more trend, friends, we've seen is there's a very sharp polarization that has happened in the market in the last 12 or 18 months. Very few select sectors, and within these sectors, very few select companies have done well, and a large breadth of the market has not done well in terms of returns or in underperformance. This is the sectoral breakdown in terms of, as you can see here, very few sectors have done well, and a large part of the sectors have not done well. Some of the heavyweight sectors like financials and others have not done well, whereas some of the narrow sectors have done well. So the rally in the market has been very narrow in the last 12 months or so. But I think we are at a point where this mean reversion is already happening, because now the economy got impacted because of tariff, 50% tariff which was imposed on India, and then after that, by the moment we got the trade deal, we got into this whole Iran war, and oil prices escalated, which had a consequent knockdown impact on the economy because of higher fuel prices and eventual impact on currency. But now all of that is in the base. The economy is already showing signs of broadening, where growth is coming back. It's much more broad based, and I think markets also becoming more broad based, and those initial signs are already visible in the last 4 or 5 weeks since the signing of the peace deal. It's already visible in markets, and I think that's the growth story going forward, and which is what I think will play out. Just a quick to summarize all of this, the point I'm trying to say is Indian economy is fairly resilient. And growth, we had some slowdown in corporate earnings growth, but that earnings growth is reviving and it's coming back. And while this year will still be double-digit growth, but I certainly think that corporate earnings growth will go to mid-teens, 15-16% growth next year, which is a very good sign that after 1 year of 4% growth. We're getting back to mid-teens kind of a growth. As I said, market breadth has already started showing signs of improving, and markets will become more broad-based as opposed to the narrow market that we have had in the last 12 or 15 months, which effectively means that more opportunities, more sectors, more companies to invest into, and more opportunities to be making money. As I said, after 2 years of underperformance, valuations have become attractive on every parameter, on Indian market standalone basis, on absolute basis, on a relative basis, and also relative to the world as well. India has become relatively attractive. And now majority of the global investors are underweight India. So as India starts performing, global investors some point of time will come back to Indian markets. Large part of, as all of you know, large part of returns in global equities in the last 18 months have been made by a single theme, which is AI, and money has gone into countries, and within those countries into narrow set of stocks which are driven by this whole AI theme. But as I've been calling out for some time now, I think probably that trade is closer to, is already peaked. The peak of that trade is behind us. AI stocks have gone far too ahead versus what the long-term fundamental valuation of those companies are, and that trade in the last 3 or 4 weeks is already showing early signs of reversal. And if that reverses, then please remember that India is a reverse AI trade, which effectively means if money comes out of AI stocks, it will also come out of countries which are dominated by AI themes, and those countries do not have a durable, endurable long-term growth story. They don't have secular growth story. These are all cyclical markets which are riding on a single theme, and as that theme peaks out, those markets will peak out and in fact will correct very sharply. We're already seeing very sharp volatility in some of these markets. I'm sure some of you have seen what has happened to Korean markets in the last 2 or 3 weeks. And once that money comes out, that money will try to find a home into long-term secular growth story, and which is where India stands out. So I'm very hopeful that probably by the end of this year, foreigners will start returning back to India, and probably next year will be a big year for India, where the next few months looks like to be volatile for global equity markets, but I think the volatility in India will be much lower. And as global markets correct, India should be a reverse trade, because we already corrected much ahead of those markets and we have not participated into that global AI frenzy that has been playing out into equity markets in the last 18 months. So now that money is taken out of those markets, money will come back to India. So India could be an inverse to what happens global markets, and which is why I'm saying that probably this is a very attractive time to be investing into Indian equity market, because we do not get such attractive entry points very often. These kind of things happen once in a 10-year kind of a thing, and which is what the opportunity that lies ahead of us as we stand today. A quick update probably on Renaissance portfolios, how we are positioned, and then I can quickly move on to taking questions, because I can already see there are a lot of questions in the inbox that are already there. As all of you know, friends, as investors, we are very fundamentally oriented. When we invest basis underlying fundamentals of the companies. When we buy stocks, we are buying cash flows of the company at a reasonable valuation or at attractive valuations. We are not trying to play momentum. We never try to play momentum in stock prices, because please remember, momentum never has a soft landing. Whenever you are playing momentum in stock market, momentum eventually always at all times in history in markets has a crash landing. It's very dangerous to be playing momentum. In fact, what we do or practice as an investor is we try to sell into momentum and buy into good quality growth company at reasonable or attractive valuations, which is what we have done exactly in the last 12 months. That we kept on selling into momentum and we went on buying into companies where high quality companies which can deliver healthy growth over the next 3 to 5 years. And those companies, I must admit, were available at reasonable valuation and in some cases at very attractive valuations. These kind of opportunities, this kind of very sharp divergence of polarization in the market happens once in 6-7 years. And when you get these kind of opportunities to buy high quality businesses at attractive valuations, you should not let go of them. You have to capitalize on them, you have to capture them, and which is what we've exactly done in the last 12 months. And which is why I firmly believe that our portfolios are rightly positioned for the next cycle of growth in the underlying growth in the economy, and consequently in terms of how markets are going to perform or the sectors are going to perform over the next 4 to 5 years. Our portfolio already positioned there. So as market mean reverts, as global cycle mean reverts, I think we've spent last 12 months building this portfolio when you are in this process of portfolio transitioning your portfolio, it is always painful in the short term. We've taken that pain last year, but I think we are perfectly poised for very healthy returns and delivering strong returns over the next 3 to 5 years, as we have done in the last 6 or 7 years. Also understand, I just want to make one more point, that please understand, all of us know that stock market makes bubbles and then stock market crashes, right? So it's very logical for a rational value investor like us, growth biased value investor for us, you don't want to outperform anyone who's trying to outperform the market in the last leg. We'll have to play the bigger fool's theory, that you have to become a bigger fool or bigger maverick than the market to outperform the market when market is doing crazy things or market is creating bubble. And if you try to do that, then please remember that when market falls or corrects sharply, your portfolio will fall much more than that. As a rational investor, as an active investor who's rational, we are not buying stock prices, we are buying, as I said, we are buying underlying cash flows of businesses. So we want to consciously underperform the market in the last year of which is generally a 7th year or 6th year of a bull market. We want to underperform that market, because we don't want to participate into the madness of the market where valuations are extremely rich and extremely frothy, because that will end up very badly, which is what we have avoided. We have sold into those momentum. A lot of these stocks which are doing well or which have done well in the last 12 months, these are stocks which we bought in 2019, 20 and 21, especially the industrials and cap good companies, when no one was buying them. They were out of flavor, they were available at a very attractive valuation. Today some of these sectors and some of these companies are the most hotly chased companies, and because they've done well in the last 5 years. But when companies become so hotly chased and everyone is chasing those companies, obviously you know that the juice is taken out of these companies. What is left is very moderate or modest returns, and more importantly valuations are very rich, which effectively means the risks are very high. So we want to be sellers into those momentum. So we have stuck to our DNA and discipline even in the last 12 months. In the process, we have taken some pain in terms of performance, but I think this will work well for us in the next 4 to 5 years. Having said that, our portfolios are broad-based. These are some of the key sectors where our portfolios are positioned. Probably almost 60% of portfolio is between these sectors. Financials is the largest positioning at 30-35%. Did take some hit during this whole war because of macro concerns and of oil prices and rising bond yields, but we think all of that is settled. Macros have settled. From here on, they should do well, and some of our companies are doing all of our companies are doing incredibly well. Likewise, we see strong resurgence or revival in India's consumption sector. FMCG sector has underperformed for last 6 years. We see after 6 years of underperformance, valuations in the sector has become normalized, and we see growth returning back to the sector, growth acceleration in the sector. We are always looking for growth acceleration. Where is that delta growth where companies and sector will grow earnings growth higher than the index earnings growth, and within that, which are the highest growing companies? We're chasing growth, high growth with quality and reasonable valuation. Likewise, autos, we see very strong growth, and so as with power and with IT as a sector. Quick update on our Indian strategy. All of you all know it's a multi-cap strategy or flexi-cap strategy. Currently, portfolio is 40% large cap and 60% mid and small cap. We've used the crisis of this whole oil crisis and the war to increase our mid and small cap exposure by almost 7-8%. So we actually increasing the risk profile of the portfolio, because we feel now more comfortable with those risks, and within the sector, more risk, but risk within sectors and within those companies which we feel good about. You can see the top 5 holdings are here. It's a fairly diversified as opposed to the markets which have been very concentrated. Our portfolio is very broad-based, because I expect or anticipate a very sharp mean reversion in markets, and that's already started playing out in the last few weeks, and I think this trend will only accelerate going forward. So the portfolio is fairly diversified across 10 sectors. Financials, as I said, is the largest sector, followed by autos, internet, IT and consumer. As you can see, the top 5 sectors here. Portfolio has healthy earnings growth, about 15% this year and about 17% next year. And as we go through this cycle, another quarter's time, probably we will make some changes in the portfolio to increase our FY28 earnings growth, because once we get the growth cycle, confident growth cycle back, we want to take our earnings growth higher for the portfolio, which we will do. And more importantly, portfolios are very attractively priced. at earnings growth which is ahead of the index, and valuations which are portfolio valuations which are at 20% discount to the index, as opposed to FY27 index valuation of about 18 times 1 year forward earnings. Our portfolio is at about 15 times, which effectively means portfolio has a lot of embedded value into the portfolio, which will get unleashed or unlocked or get monetized in terms of returns. And qualitatively pretty healthy portfolio at 16% ROE, 17% ROE, which effectively reflects the quality of the portfolio. Pretty healthy portfolio. At risk level, portfolio is positioned perfectly in line with the market. The portfolio beta at 1 means effectively we are taking market risk in the portfolio from a volatility perspective. So we are very mindful of that fact. We want to take risk, but not risk higher than the market, and which is what exactly we are keeping the risk at the market level. How can we enhance returns of the portfolio, and which is what exactly we are doing with the portfolio. Quick update on the performance. As you can see, last 5 year portfolio has done 17% CAGR, 6 years 29% CAGR, and again 7 years 16.6% CAGR. Very healthy returns over the last 5-7 years. We've had tough 1 year, but as I said, last 1 year has been a period where we've been making portfolio changes, and as a consequence we have sold into some of these lot of these momentum stocks early, which are now reversing, and some of these stocks are reversing very sharply. All of this will work in our favor. Our portfolio already started showing traction. Last 3 months you can see the portfolio is up 10%, very healthy rebound, and you see on a financial year basis the portfolio outperformed the markets every financial year in between FY21 and 25. As I said, last year was a year of portfolio readjustment because market cycle have peaked. We think the leaders in the next cycle will be very different sectorally and also company wise, and we want to be positioned rightly in the market. As we made this transition, we did underperform the market last year, but this year we'll be back to our strong performance cycle, and we are well poised for that. So every 6-7 years as market cycle changes, as I said earlier, I just want to reiterate once again. In the last year when market cycle is changing, we don't want to outperform the market, because otherwise our portfolio will also have a very sharp drawdown, which we don't want. We tend to anticipate such market mean reversion and try to do things slightly more proactively. In the process, we want to consciously underperform the market at the peak of the cycle, and which is what we have exactly done. So this is exactly in line with strategy for us. There's nothing which comes as a surprise to us in that sense, and we feel very good and confident about our portfolio performance and positioning. Maybe a quick update on our Renaissance Opportunities portfolio. As you all know, the portfolio is large cap portfolio. The portfolio again 65% large cap, 35% mid and small cap. You can see the top 5 names here. Again, diversified portfolio across 10 sectors. We've sold into industrials and a lot of momentum sectors where we had a lot of ownership and we're significantly underweight. We have by and large exited, meaning we are exposure to industrials and cap goods, which I think is a high momentum sector. Valuations are very rich, has been pruned down drastically. Again, portfolio with accelerating earnings growth of high teens over the next 2 years. Valuations very attractive on a FY28 basis, 14 times earnings, extremely cheap, meaning in terms of valuations, and a very high quality portfolio at 16% ROE. And market risk again in line with the index, market risk again in line with the markets at 1 beta for the portfolio. So I think every metrics that we look at on the aggregate portfolio basis, in terms of portfolio construct, in terms of dispersion across sectors, in terms of portfolio underlying fundamentals, portfolio risk, we feel pretty good about our portfolio. And we think we are perfectly positioned for the cycle that lies ahead of us over the next 5 years. In terms of portfolio returns, 5-year CAGR of 13%. All of you will know it's a large cap portfolio. Index returns, Nifty 50 TRI has been 10%. 6 years at 21% versus Nifty 50 of 16%, and 7-year returns of 14%. Last year again has been a 3% underperformance or thereabouts on last 1 year basis, and likewise in the last financial year as well. But before that, last 5 years we have had strong outperformance, and I think we are poised. Portfolio has already started rebounding. You see last 3 months performance is in line with the index. Our portfolio are very much there. The markets will turn around going forward, and with in for a very sharp rebound in this portfolio. And I must concede that the 5-year return, we want this portfolio to deliver at least 15% return on a 5-year basis. They are somewhat lower, but I think we will have a catch up which will play out over the next 12-18 months, and we will get these 5-year returns above 15%, because the targeted returns for this portfolio at the lower end is at least 15%. So they're somewhat lower, but that's also to do with the underperformance of Indian markets over the last 2 years. But I think we'll have a catch up on that in the next 18 months. and this will revert back to 15% plus kind of a thing is what we envisage. So I think our portfolio is perfectly positioned. As you can see, last 3 months the portfolio is already performing in line with the index. So these are some of our historical holdings which we invested, which have done well, and the kind of returns we make. Probably I can skip this in the interest of time. The last thing, the Indian X strategy has been consistently ranked on a 3-year and a 5-year basis, has been ranked among the top 3 funds consistently for the last 3 years in terms of consistent performance across 24, 25 and 26. So that reflects the 3-year consistency of returns that we've been able to deliver with the fund. And obviously importantly, this ranking has been done for risk adjusted returns. While absolute returns are important and we've done well, but what is equally important is the risk you take to generate those returns. On a risk adjusted basis, the strategy is done exceedingly well, and it reflects our consistency in terms of performance on a 3-year basis. And I think I have no doubt in my mind that we'll keep doing that. So with that, maybe I can pause here. I can quickly, I think I'm already I've exceeded the time, already 45 minutes into it, and I can try to quickly address questions. I can see a lot of questions on the inbox. So let me take those questions and try to address as many as I can. If for constraint of time we are not able to address all the questions, we'll certainly write back to you, with the replies. So let me begin with that. The first question I can see is, global markets are highly volatile right now. Why is India's long-term growth story still remains intact? Well, all of us know India, as I say, India is in the midst of a growth super cycle or an economic miracle. So I think nothing has changed on that count, because India is a very large economy. India is a very stable economy, and our growth is very diversified. And the good thing about Indian economy is we have very strong domestic drivers of growth, including our demographics. All of us know 29 years, strong labor force addition, very high savings rate, and very strong domestic growth. So while we want a stable world to accelerate our growth, but in times of turbulence, where the world goes through turbulence like we had during this whole Iran escalation or what's been happening in the world in the last 18 months, India's domestic growth or domestic economy becomes a very strong anchor for India's growth. So I think the long-term growth story remains very, very much stable and in place. As far as global market volatility is concerned, obviously it's driven by this whole higher oil prices. Secondly, with this whole AI trade peaking out, because that's been a big driver of returns. But I think that trade has gone. Equity markets, I've been calling this out, that India, this AI is, as far as stock markets is concerned, AI bubble has popped out. I've been calling it out for the last almost 10 months. I think now markets are reflecting that AI companies are grossly overvalued. When someone is selling, you might be the the most intelligent man on the planet, which is a given, yet eventually markets are driven by valuation. If someone is selling you hallucinating stories about the next orbit and next and extraterrestrial planets, and markets are giving it $2 trillion of value, all of us know what's happening with markets. Yes, obviously I'm talking about SpaceX. So the signs of visible bubble are so obvious that there is a big bubble in global equity markets. So I think they will remain volatile. In fact, there will be my view is that there will be a very sharp correction in global markets, and India will be a beneficiary of that. What is the next question is, what is the biggest growth driver for India today? I think, as I said, India's domestic economy and India is a very broad-based economy. There are multiple engines which are firing. That's the beauty of India. That the economy is not dependent on a single engine. You look at Korea, because that's been the best performing market in the last 18 months or so. The underlying growth in the Korean economy is just about 2%. The markets have done well because it's a single engine economy, and that engine has been firing full throttle in the last 18 months, which is that whole semiconductor story across primarily the two companies, which is SK Hynix and Samsung. So it's a single engine economy. You look at Taiwan, it's a single engine economy. India has multiple engines, and that's the good thing about it, that you have multiple engines firing. So I see growth across sectors in India. When I talk about consumption recovering, we see consumption recovering across staples, discretionary, autos, and everything else. When I say financials doing well, meaning there's industrial growth in the economy, manufacturing is reviving and picking up. Services economy is doing well. So there are multiple engines to India's growth, and all of those engines, meaning some of those are firing. They are firing at different speed, but the economy is a multi-dimensional, multi-engine economy. It's not dependent on a single economy, and which is what the good thing about the economy, which is what gives us stability and resilience to this economy. The next question is, can India outperform other emerging markets? I have no doubt in my mind that over the next 1 year from here, the next 2 years and 3 years, India will be the best performing will be amongst the best performing emerging markets, if not the best, because as I said, this is AI, infrastructure investment, and whatever is happening with the semiconductors and all of that is a cyclical trade, and that trade has played out. Long-term secular growth stories, there are not many in the world, and very few. And within those secular growth economies able to deliver 7% real growth are not there. India probably is certainly is the only place which can deliver 7% secular growth story. So there is no reason. I firmly believe that the worst of India's underperformance is behind us, and Indian markets will I firmly believe Indian markets will outperform from here over the next 1 year, 2 year, 3 year, and 5 years as well. The next question is, if you had fresh money to invest today, where would you deploy it? Large caps or mid caps? Which offers better opportunities today? Well, I would, if you really ask me, I would buy a combination of both for two reasons. One, large caps, because of the kind of relentless selling we have seen from foreigners, and because foreigners had very large ownership in a lot of these large caps. Large cap valuations have become very attractive. You can buy the largest bank in India at 13-14 P. HDFC Bank valuation at these valuation happened only during COVID. So, and COVID was a crisis, or it happened in 2008 financial crisis, right? So you can buy some of these large cap companies at really attractive valuations. So one should definitely invest there. Having said that, I find equal pockets of opportunities in mid caps as well. So I would actually play it across both segments of the market. Oh, next question is very interesting. The question is, has AI changed the way you look at investments? This question has two dimensions. I'll try to address both. I'm not sure which one who's asked the question meant. One is, has it changed the way we look at companies? The answer is emphatic yes, because AI is going to challenge each and every business, and we are certainly looking at every business in terms of what impact AI will have on that business. AI can be an enabler, and can be a tailwind, or can be a disruptor for a business. Now it's left to each business whether you look at it as an opportunity or as a threat, and more importantly, what is the business doing to adapt to that AI. So definitely we are looking at this incremental dimension, which we are looking at every company when we are evaluating business in terms of whether AI is a tailwind, a strategic opportunity, or a disruption, and what the company is doing about it. Secondly, in terms of our own internal investment processes, have we started using AI? Not yet as much, because we are still waiting for some good, models, SLM models, which can solve a lot of things. But I certainly believe over the next 3 years, we can use AI in our research processes to significantly enhance the productivity of our research, and we will do that. We have evaluated certain models and all of that. I think there's still a lot of people trying to build a lot of solutions around it. We're waiting for the right solution. Once that is available, we are going to certainly adopt and implement that, and I think that will change things very significantly, which will significantly improve efficiency and productivity of our investment team, resources, and people. So I'm very excited about that, and the benefits that can come because of that. I'm really looking forward to that. The next question is, what is the current state of US-Iran peace negotiations, and how do you see the geopolitical situation evolving? Well, I know about the peace negotiation as much as you know, because all of us get to know it over Twitter and Truth Social, and we know every day is a new day with new set of tweets. So I think that is how it is. Having said that, how do I see situation evolving? I think as far as this specific US-Iran thing is concerned, I think somewhere we'll have to find a middle path, where I think more and more countries, because global economy is at stake, I think more stakeholders will get involved globally, and they will try to push or nudge both US and Iran to get to a middle path, to get to a deal which will be more long lasting and sustainable than 3 weeks or 4 weeks, on terms which are more acceptable. So I think both sides will have to make compromise and get into an endurable deal which can sustain beyond 3 weeks, kind of thing. I certainly see that happening. If you ask me, that is the eventual path I see. Now, whether that happens in 2 weeks or 6 weeks or 12 weeks is to be seen, but I certainly see that happening. The next question is, where do you see crude oil price settling over the medium term, and what could be the impact on Indian economy and Indian markets? I've touched some of these during the course of my presentation. I still believe that crude oil markets are well supplied. There is no scarcity of supply as far as oil is concerned. So once Hormuz normalization happens, I see oil going back to $70. And in fact, if at all anything, over the next 18 months, there is a downside risk to oil to probably going to $60 as well, because oil markets are well supplied. There is no dearth of oil availability in global markets. So I think oil, I would expect oil settling down at somewhere around $70 once we have normalization of Hormuz. Which stocks and sectors are you avoiding right now? Along with the rationale is the next question. As I said, I see pockets of markets where valuations are too rich and are far ahead of time, and I see pockets of markets where there is bubble, and which is what we're clearly avoiding. I've been saying this for almost now 9-10 months that globally the AI bubble has popped out. So in India also we have some derivatives on AI, companies which are derivative or which are play on a global AI. And also a reflection of that is visible in industrials and cap goods as a sector. So we are taking our money out of, we've taken significant part of our money out of those sectors. We have very small little money left in that sector. Otherwise, we think valuations in that sector are very, very rich and far too ahead of what cash flows and business fundamentals can justify over the next 2 to 3 years. So that's one sector where we're clearly taking money out. Other sector we are avoiding is metals, because we think the metal rally into metal prices and metal stocks in the last 12 months was driven out of supply squeeze rather than by a real strong demand. And now if Hormuz normalizes, Middle East normalizes, we don't see that supply squeeze lasting for a long period of time, and which is where we are taking money out of commodities and metals as well. So we don't own significant amount. We own very little of metal and commodities, and we've taken money off that. Okay, the next question let's move on to is, what's your one message for investors betting on India's future? Interesting question. My simple message is have faith, absolute faith and confidence in India's future. Indian economy is, I've been saying this for almost last 5 years now, that we are in midst of a economic miracle. Economic miracles, when they happen in any country or economy, they are not short term, 1 year, 2 year, 3 year stories. These are long term trends which play out over the 15-20 years. Something similar has played out in all the developed economy at some point of time in their history. It has played out with UK, which was the first economy which ever got industrialized in the 17th century, has happened with US, has happened with Japan, happened with China, and is playing out in India. It's a 20-year story. So have absolute faith in Indian economy, and consequently the best, meaning Indian equity is the best way to leverage that. So just stay invested. The world will remain volatile. World will go through its own challenges. India will keep navigating that and will keep moving forward, and related to the world will keep growing or increase our market share in the global GDP or output. We are on that journey and will continue to remain on that journey, irrespective of whatever happens in the world. The next question is from Mr. Manoj Sharma, which is future of Indian economy in wake of huge disruption and no allocation for research and innovation. I'd explained or expressed my views on the future of Indian economy. I take your point that the world is in the midst of a huge technology-led disruption, and as Indians, as a country, as a society, we are grossly underinvested into both research and innovation. I agree with that. One, what I want to say on disruption is, see, eventually AI will get into implementation and adoption phase. The first 4 or 5 years when you get a new technology is about infrastructure build out, which is what is happening. Once we get into the adoption phase, India has a very important role to play, both domestically as Indian companies and consumers and governments as we adopt AI to improve our efficiency and productivity. And there's so much low-hanging fruits in India as a country to enhance the efficiency and productivity very significantly. So that's a huge opportunity for us, and also for the world, because we will play a big role as the world adopts AI in terms of implementation, helping the world do that. Because as you all know, IT services companies have a very big role to play in that, and 60% of global IT services companies are Indian origin companies. So I think we have a lot to offer to the world in terms of AI adoption, implementation, and help the world also to adopt the AI. As we adopt ourselves, we also help the world in adoption of AI. Indian IT companies are going to play a very big role in that. So, and yes, you're right. Probably as a country, probably we'll have to increase our investments into research and innovation, so that unlike this whole AI infrastructure wave we have missed, the future cutting edge technology, we can be right there, participating in them at the time where they're evolving, rather than trying to chase those technologies as we've been doing in the last 20-30 years. The next question is from Priyansh, which is India a good bet despite the AI boom? There are opinions that FI is looking for a bet away from AI can consider India as an investment hub. As I said, Priyansh, undoubtedly, it's not that India is completely left out of the AI boom. What India does not have is AI infrastructure play. Plus, please understand, infrastructure build out, whenever new cutting edge technology evolves or comes, infrastructure build out happens, significant part of the initial infrastructure build out happens in the first 5 years. The next 20 years are about adoption, implementation of that technology, and India is very much there in that adoption and implementation. So it's not that India is completely left out. What India is left out is out of the AI infrastructure build out, and not out of the adoption and implementation wave. So now India will start participating into the AI implementation wave, and India will not be left out. Foreigners eventually will look at secular growth stories, and I think India has a very compelling secular growth stories. We've already run out of time. I can see a lot of questions already still there. I'll just take the last one, and some of the other questions, our team will get back to you with the replies. The last question is from Vanshika, which is, what are some of the factors you are seeing which will not come into play like they did when India's growth story initially fell apart? I think what she's saying is, what are the risks and what gives you the confidence that that risk will not play out? Well, if you ask me, meaning the biggest risk for India, I would still concede, is higher oil prices, because energy is a very essential part of the economy, and we import 90% of our energy. So if you ask me, and we don't have any control on that, but having said that, eventually if a crisis like Iran or Hormuz does happen, all we expect is that eventually these crises will get solved and supply normalization will happen. So any of those risks are of escalated or higher prices will be only transitory for a period of time and cannot be for a longer period of time. Apart from that, I think we are very much in place. The good thing is, we have a democracy, so we get our election cycles and so on and so forth. So I don't see significant risk apart from that from a longer term perspective for India growth story. In the short term, on a yearly basis, something or other will keep happening on the world, and that will impact India. Structurally, I don't see significant growth risk to India growth story. I don't see structural risk, though there can be cyclical risk which can keep playing out on an every year basis. Okay, maybe one last question and then we'll just wrap it up, which is, do you have a fund where we can participate in the AI story? We are very much launching a fund in the next few weeks, where we intend to invest into companies which will be a big beneficiary. India's AI story, while the AI infrastructure story in the world has played out or is near peak, India's AI story is just started unfolding and it will play out over the next 10-15 years. There are a lot of interesting and I must say exciting investment opportunities in India's AI story, and we are just launching a fund which will be playing out, investing a significant part of the portfolio into India's AI stories. We're just launching the fund in the next few weeks. So do get in touch with our team and they'll help you with details of the fund. With that, friends, I've already exceeded, we are already 10 minutes past 5. So let me thank all of you all for taking your valuable time out and joining us for this webinar. If you have any further questions, feel free to reach out to our team. Very happy to answer your questions. And as I said, I feel pretty constructive about Indian equities after underperformance of 2 years, and also more importantly about how our portfolio are positioned for all the changes that we have made in the last 12 months. I think we're perfectly positioned for the economic cycle that lies ahead of us for the next 3 to 5 years. On that note, I thank you all for taking your time out for participating in this. Thanks a lot.